Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I'm joined by Carl Chung from Ninepoint. Welcome back to the channel, Carl. How's it going?
Doing well, Adriano. Always enjoy our sessions together. We just saw each other at the Blossom event, which was a big highlight. So great to see you in person. And
Yeah, same.
everyone was just excited about the event.
Yeah, for about 7 seconds, that's pretty much all the time we had together. Your booth was swarmed. I was getting pulled left and right. It was a pretty crazy event. It was fun though, for sure. But pretty successful event. Lots of people. So yeah, it's always exciting to see more and more retail investors, becoming investors, right? It's very important. So today we're gonna follow up on your 9 point income shares, right? Your high shares rather. So I'm just curious, we've already done a previous Q&A to discuss more the ins and outs. We're gonna touch on a few points. So first I want to know, how's it going so far? Have you been surprised by the reception? What is I couldn't find it on your website. What's the total AUM for
Yes.
especially the all-in-one? I'm always very interested, mostly, and so is my audience, typically in the all-in-one, which is ECHI. In case people don't know what we're talking about, this is the 9 point high shares all in one, which means it's an ETF that's going to hold all 10 of the single tickers, right? And you have the tickers here, the companies here. So how's it been going so far?
No, it's excellent. And just to comment on the Blossom, I feel the
Yes.
questions, and we saw about 500 of the 1,200 registrants at that event. And what's amazing, just been doing this for a little while, but a few years ago, people would just ask, what's the yield?
Yeah.
At that event, I was hearing things like, what happens to the option income if volatility drops? How does leverage affect the income and the downside capture? So it really shows a shift in the retail investors becoming way more sophisticated. And that's really encouraging to see from our perspective.
Same. It's about education. That's what my channel tries to focus. And this is why I love having you guys on, right? The guys who actually manage or in charge of these funds to get the information firsthand. So we don't have to guess or go on Reddit or something to maybe get some information. So this is why
That's
I like
good.
having you guys. So, but yeah, the Toronto Blossom event was cool, and I am definitely also seeing the maturity, especially in the options covered call space. I've been doing this for over 5 years, trying to educate people and going in digging in deep, right? So, how's it going
And
so
you
far?
were definitely
Yeah.
the most popular guy there. So I'll just
Oh
say
no,
that
I
for your
wasn't.
audience.
I wasn't. I wasn't.
So get back to the 9 point just on the
Yeah.
update. So in terms of reception, it's been great. We've passed now, when we take a look at internal measures, 70 million across the suite. That includes the all-in-one, as you mentioned, ECHI. And what's been interesting is not just the number, but how people are using it. You have investors that are choosing the individual names like Cameco or Barrick, but they also are targeting others that are looking for a single stock solution. The all-in-one ETF ECHI, as you mentioned, is now close to 25 million in AUM since we launched August 21st, 22nd, I should say, and which is automatically, just in case your audience needed a refresher there, but they automatically spreads across the 10 different names on a yield weighted basis. So it really depends on the investor styles, but we see them using it in different ways.
Interesting. So the first distributions have finally been declared. I know you had estimates before. So I believe for ECHI it's been 15 cents, right?
Correct.
15 cents a share. So is this what you expected? Tell me a little bit about the distribution amounts. Is it what you expected, and what do you see going forward as well? A consistent 15 cents, or what would you say? Because as you know, and I'm sure you've heard from people at Blossom, the distribution amounts for income investors, the consistency, the sustainability is a very, very important thing.
100%. And here's the easiest way to think about it. The income comes from three levers. Of course, ETHI is investing in 10 different single stock ETFs, but each one, depending on the dividends. So, for example, RBC pays a quarterly dividend, so that gets built in gradually. The second one is the option premiums. If volatility is high, which has been relatively high since we've launched, I think Shopify journey earnings premiums, et cetera,
Mhm.
that certainly is factored in. and then leverage up to 25%. It can increase the income, but also increases the volatility on the downside, which is good and bad. So yes, the 15% is what currently has been paid. We just had our record date and payment date. So investors got their first distribution. But we can move it up and down really depending on the volatility and the option pricing. Your viewers are very well educated in this area. It's managed, it's just not promised. And that's a good start
Right.
that we've had so far.
Okay, so yeah, I was just gonna ask you about the distribution sustainability. So would you say that you guys will never pay out more than the fund earns and you will adjust the distribution, not only on the all-in-one, I know we're focusing on the all-in-one, but also on the
Mhm,
single tickers.
mhm.
I'm assuming in the single tickers, you'll probably see maybe some more variability in the distribution, but you'll adjust if necessary, up if you can, down if you need to. Is that the attitude that you guys are having towards distributions?
Definitely. And then going back to the expectation of the end investors, they prefer to have smoother distributions based on earned and potential income via the underlying capital gains. And so we will definitely take that into account as we distribute and pay throughout the year. And then taking into account the volatility and option leverage. Right now, since we've launched into a rising marketplace. We just paid our distribution. Most of the NAVs are above $10. Of course, if the performance is cooperated that way. But take a look at the Shopify's or Camicos. They've been performing extremely well, and we paid out sizable distributions amount as well. So we'll certainly factor that in over time.
Yeah, and these are all actively managed. So in a rising market, rapidly rising market, especially Canada's been on fire lately, would you say that your portfolio managers are kind of toning down the covered calls to capture more upside when they see that? This is an active approach that you're doing, right?
Mentioned that. Yes, that's the goal. An example using Cameco. Cameco
Yeah.
goes from 50 to 52. This covered call ETF, CCHI, uses modest leveraged and controlled option coverage that aims to move in the direction of the stock while generating income a lot along the way. The trade-off is simple. You get these consistent premiums,
Yeah.
but you do give up some upside in a sharp spike.
Perfect. Makes sense. I want to talk to you about leverage a little bit. So, personally, this is me personally, I'm a big fan of covered calls and leverage. I think that combination, modest leverage, let's say 25%, works really well long term, especially if you have conviction in the underlying holdings. But there's some fund managers in Canada, covered call fund managers, who have launched recently 33% leverage, a little bit higher. What would you say to that? Is that something you guys are considering? Are you, no, we're sticking to the 25 because that makes sense of our back testing? Are you open to the idea? What would you say to that?
We've seen these products go to 33% leverage, and naturally people are asking that. Why did we choose 25%? Let's go to the origins. At 25%, the intention is to enhance income without distorting how the ETF behaves relative to the underlying stock. So if Cameco rises 10%, let's just stick there. Over time, we want to get in that general directional movement reflected in the ETF. At 33%, yes, you're likely to pull in higher premiums, higher yields, especially in high volatile names like a Shopify or CNQ, for example.
Yeah,
But the trade off is very much a sharper downside when markets pull back quickly. And we've seen that examples in some of Trump's tweets.
right.
Before we consider moving higher, and going to your question, whether we would consider to go to 33, our approach will be very disciplined towards that. We need to run, as you mentioned, full internal back testing, stress testing through the structure, looking at different volatility environments, and really review how it behaves, not just in rising markets, but if we have these sudden drawdowns and recovery cycles.
Okay, makes sense. Now, Carl, the next question I know you can answer, but I have to, I ask it anyway. Future products, right? So you guys are having, obviously, you started with with Canadian companies. There's actually a huge market south of the border, as we know, many volatile stocks where the cover call strategy works really well. Are you guys considering maybe going into some US names, launching a US all-in-one? And again, I know you can't speak to it officially, but what can you say on that?
That's one of the biggest themes in my inbox. A lot of investors are saying, give me Tesla, give me MicroStrategy, Nvidia. I look at the chat boards; it's just incredible. Maybe even global names as well. It has been of interest more recently, and we hear that. Step one was really building the foundation for the Canadian suite, meaning we wanted tight spreads, we wanted tradability and lots of volume, and then pay some consistent distributions and predictable liquidity. As the structure behaves as we had expected, market makers also are getting comfortable in providing depth and scale. And so we think with the US and global tickers that have been uh, launched by our competitors, it really has to align with three things as we look at this. One is there has to be strong investor demand. There's clearly interest on the US side. There needs to be proper option liquidity. We talked about that depth, not just in its current market, but potentially in dual markets. The real goal in this is to really whole scale, trade tightly, and deliver repeatable income profiles. And that's how we feel you're going to build integrity with this platform, not just headlines. And you'll probably hear more things from us in the future.
Awesome. Looking forward to it. So I want to take a few questions from Inner Circle members. So in case my viewers didn't know, if you're an Inner Circle member, you have the chance to submit your questions for upcoming portfolio manager, fund manager Q&As. Just hit the little join button to figure out and see what it's all about. So the first question I have here from Sankeet. He's got a few, but I think this kind of ties in all together, all of these questions. So what would you say are the key differences between the Ninepoint, because let's face it, there's a lot of competition now in Canada, similar products. So what's the difference between your offerings and similar offerings from other players? What's that special thing that Ninepoint has where the competition doesn't have?
When you look at what makes HighShares different, we tackled this on one of our first calls. It gives investors control of how they take income. But with HighShares, you can either pick a single name ETF on the Canadian side, which was unique when we first launched, like Cameco RBC, if you have conviction, or you can use ECHI automatically, as I mentioned, spreads it across a yield-weighted basis, which we feel is a differentiator on how we are weighting the wrap portfolio. Second, this isn't a static formula. The option strategy and leverage capped up to 25% is actively managed, what we talked about, every day by a derivatives team. That means the strike selection and the volatility positioning adjusts with the market instead of just following some kind of preset rule. And then thirdly, and I feel most importantly, we launched with a 0% management fee until 2026, end of February. Then it steps up to 29 basis points, which is materially lower than most competitors in the space. And so we think we've carved out a nice cost competitive niche there. You add in a monthly tax efficient distribution and DRIP eligibility. We've had really tight trading spreads since we've launched. And the goal is simple, really to deliver that high income without drifting away from the performance profile of the underlying stock.
Yeah, 0% management fee until Feb of 2026, and then it's going to 29 basis points for the all-in the all-in-one. And I believe the single tickers same fees structure,
Same
right?
thing.
Okay, and when you say it's not, you said it's yield weighted. That's very interesting. Yield weighted, not equal weighted. I just want to make sure the audience sees that because it's important. So what you're talking about is that, you have these 10 stocks here, and hopefully we'll be able to see everything. But some of them have a little bit higher percentage. You see Cameco, for example, Shopify are a bit higher. These are more higher yielding, or rather more volatile stocks, which means they're higher yielding in terms of those call premiums. But then you have really the more boring, less volatile stocks like RBC, a little bit, and CN, of course, a little bit lower. Is that what you meant by yield weighted?
We want to make sure you have a diversified portfolio, but we also want to capture which have been the best performing stocks historically, the Shopify and Chemicals that are generating really higher yields and higher returns over time.
Yeah, no, that makes sense to me. Second question from Valveman is, and this is a question I get all the time, to be honest. What will be Ninepoint strategy during market corrections? Will the covered call strategy shift? Will the leverage shift? What do you guys think of what happens in a bear market and how you'll manage these funds during that time?
Really a good question in case of like a market crash, for example. If volatility jumps, the option premiums usually increase. So that's a benefit as it can hedge some of the downside and can offer some protection and cushion on that front, especially if there's a gradual decline. But in a fast, sharp drop, no amount of premium erases that. They're still equity linked strategies. The leverage works really in both ways. It either can boost income in steady markets, but it also amplifies the downside in sudden pullbacks. So these ETFs are designed for holding through the cycle for investors, not people trying to time a panic move for if you're looking to
Yeah,
trade or time it.
long term, these are designed for long term investors, which is what my audience is. So for sure. Yeah, and that makes sense. So Carl, that's all the questions I had today. Thank you so much for your time. You've been great. Hope to have you back on the channel. And to my audience, I'll put the link to your to Ninepoint's website where you could check out their products if they have a right fit for you in the video description below. So Carl, thanks so much, and hopefully we'll have you back again soon.
Thanks again, Adriano. Great
Take
speaking
care.
to
Have a good
everyone.
one.